This question is about derivatives. What useful function do derivatives serve in our economy? We got along quite well without them for many years. If they serve no useful purpose, and in fact have demonstrated that they can do considerable damage to the economy, why are they not made illegal, especially the naked ones? There is precedent for that. I believe that short selling of stocks that one does not own or has borrowed or has managed to borrow is illegal.
Charlie he can get worked up more on this than I can, so I'm going to let him answer that for that.
Well, I think the usefulness of derivatives has always been overrated. If we didn't have any derivatives at all, including contracts to buy and sell grain that were traded on exchanges, we'd still have plenty of oats and wheat. I mean, I think it is slightly more convenient for people to be able to hedge their risks of farming by using derivative markets and commodities. And the test is not, is there any benefit in derivatives? The question is the net benefit versus disadvantage from derivatives useful, or would we be better off without it? My own view is that if we went back to having nothing but derivative trading and commodities, metals, currencies, safely conducted under responsible rules, and all other derivatives contracts vanished from the earth, it would be a better place.
Yeah. We'll take a current example. Burlington Northern has hedged diesel fuel, which they use a lot of over the years. And then they also have fuel adjustment clauses in a lot of their contracts for transportation. With Matt Rose, does a wonderful job of running Burlington. I basically say, look, if I were running the place, I wouldn't bother to hedge it, because if you hedge it for a million years, you're going to be out the frictional cost probably of doing it, unless you're smarter than the market generally on diesel fuel. And if you're smarter than the market on diesel fuel generally, we'll go into the business of speculating in diesel fuel. I mean, if we really got an edge, why bother to run the trains? Let's just speculate in diesel fuel. But I also say, they've got and if you have an organization where you have somebody in charge of that activity, it's going to take place. On the other hand, Matt Rose has done a fabulous job, as well as his management team, in running Burlington Northern. And if they are more comfortable, or they find it useful in any way in terms of pricing contracts or anything, to hedge it, that's fine with me too. I mean, it's his company. He can figure out the best way of running it. I'll hold him responsible for how it does over time. And I wouldn't do it one way, and somebody else would do it another way. I don't think that's. I would not condemn anybody that's running a railroad for hedging diesel fuel, nor would I condemn anybody that runs an energy company like we do at Mid-American for hedging energy costs in certain ways. But I do think if we could put up a presentation or number 4 on the screen, please. I think it was said very well in 1935. In fact, chapter 8 of Keynes's chapter 12 of Keynes's general theory is by far, in my view, probably Charlie's too, the best description of the way capital markets function, the real way people operate. It's prescriptive, it's descriptive. Everybody should read chapter 12. It starts a little slow in the first few pages. But Keynes, I'm going to read this because I don't think Charlie has it in front of him. The first part of it's very familiar to people. I mean, this quote has been used a lot. But every word in this, to me, is right on the money. Speculators may do no harm as bubbles on a steady stream of enterprise. But the position is serious when enterprise becomes the bubble on a whirlpool of speculation. You can change that to gambling if you want to. When the capital development of a country becomes a byproduct of the activities of a casino, the job is likely to be ill done. That's the famous part of the quote. Keynes went on to say, the measure of success attained by Wall Street, regarded as an institution of which the proper social purpose is to direct new investment into the most profitable channels in terms of future yield cannot be claimed as one of the outstanding triumphs of laissez-faire capitalism, which is not surprising if I am right in thinking that the best brains of Wall Street have been in fact directed toward a different object. That was written in 1935. I don't think there's been anything better written about how government, how citizens should look at Wall Street and what it does and it does. It's always had this mixture of a casino operation and a very socially important operation. And when derivatives became popular and the more academia was behind them 100%, they were teaching more about how to value an option than they were about how to value a business. And I witnessed that and it drove me crazy. But in 1982, Congress was considering the expansion of a derivative contract to the general public in a huge publicized way. It was the S&P 500 contract. That changed the whole derivatives game. At that point, basically Wall Street just said, come on in and everybody can speculate in an index, not any real company, just an index. And you can buy it at 10 o'clock in the morning and sell it at 10:01 and you're contributing to this wonderful society by doing it. And I wrote a letter to Congressman Dingell, and if we'll put up Exhibit 5, I just excerpted a few of the statements I made there. And I said, this was 1 month before they put in trading in the S&P 500 April. They put it in April 1982 in Chicago. They did a little in Kansas City first. And I went through 4 pages of things, and I just pulled out a few things. But I think that to some extent what I forecasted then has turned out to be the case, and then it got squared and all of that in terms as both the people in Wall Street kept dreaming up new and new ways for people to gamble, and as I say, academia was applauding all along the way and getting hired as consultants to various exchanges to tell them how wonderful they were in terms of their social purpose. And I think that, well, it's up there for you to read. I'd be glad. The whole letter was reprinted, I believe, in Fortune at one time, Carol, but was it?
By the way, this was, if I remember right, this was like the only letter in opposition to this uniformly acclaimed new world of better gambling in things related to securities. Warren wrote the letter all those years ago, and it was the only letter.
Yeah. Incidentally,
he basically said the idea is insane. It'll do more harm than good. Then as now, people didn't pay that much attention to him.
And I'll venture that very few people in this room know, you all know that if you buy a stock, you have to hold it for a very long period of time to get a special capital gains treatment on it. If you buy an S&P 500 contract at 11 o'clock and sell it at 11:01 and have a profit, it's taxed 60% as a long-term capital gain and 40% as short-term capital gain. So you really get better tax treatment if you're gambling on an S&P 500 derivative, which is what it is, in Chicago, than you do if you invest for 4 or 5 months in some security and then have to sell it for some reason. It's a tribute to the lobbying power of a rather small group that has done very well off this particular activity. Charlie, can you think of any reason why it's 60% long-term gain if you hold something for 30 seconds?
Well, of course it's crazy. It's neither fair nor sensible. But if a small group with a lot of money and influence cares a great deal about something and the rest of us are indifferent, why, they tend to win before our legislative bodies. That's just the way it is. I always liked Bismarck's remark that you shouldn't watch two things, sausage making and legislation making.